Hello everyone. Welcome to the analysis of the part 2 of the budget and economic survey. In the last week, wherein I had covered the part 1 of the analysis of budget and economic survey, in that particular part, I had covered the theme of growth and development. In this particular video, that is part 2, I shall be focusing on the theme of public finance. In this particular theme, we shall be discussing the present state of public finances, the important budget announcements, as well as the proposals related to taxation. So let's start our analysis with respect to public finance. So before that, let's have a brief understanding about the overall importance of the chapter of public finance for your prelims examination. As you can very well see, in the last 14 years, almost 31 questions have been asked from the chapter of public finance, which means on an average, you could very well say around 2 questions every year from the chapter of public finance. Now, with respect to from where generally questions are asked, you can just have a look at the breakup. Generally, questions are asked with respect to provisions related to budget. So you must be knowing Article 112 of the Indian Constitution provides for annual financial statement to be presented by the government before the parliament. The annual financial statement is basically a details of the receipts and expenditure of the government. This annual financial statement should distinguish the revenue account from the capital account. Apart from that, the annual financial statement should provide the details of receipts and expenditure of the government under 3 heads, which includes Consolidated Fund of India, Contingency Fund of India, and Public Account of India. So generally, if you analyze the previous year questions are asked with respect to revenue budget and capital budget, or questions have been asked with respect to Consolidated Fund of India. So these are some of the things which overlap between polity and economy. Second, questions have been asked with respect to taxes. So in India, we impose so many taxes. But in general, UPSC generally asks questions related to the important taxes in news. Example being, in the year 2013-14, UPSC asked a question related to capital gains tax, which was in news due to the Vodafone tax controversy. Somewhere in 2016, UPSC asked a question related to equalization levy, which was in news with respect to tax which was imposed on digital companies such as Google, Amazon, Facebook, and so on. Latest, in Prelims 2023, there was a question with respect to taxation of InvITs, that is Infrastructure Investment Trust. Thirdly, questions have been asked with respect to deficits or the debt. For example, repeatedly questions have been asked with respect to what steps can the government take to reduce the deficit. Similarly, questions have been asked with respect to debt, such as the external debt of India, with respect to government borrowings. Lastly, repeatedly questions have been asked with respect to Finance Commission. Like in Prelims 2023, there was a question with respect to what is the criteria adopted by Finance Commission for horizontal distribution of taxes among the states. So all of these things you may have already studied as part of the static part, right? Now when it comes to budget, the budget goes into current developments related to these things. So whatever you have studied in your static part, that you need to combine with the budget announcements, which is the current developments. But combining the current developments with the static part, you will get a thorough understanding of public finance, which in turn makes it easier for you to solve the questions in the prelims examination. So accordingly, in my discussion, I will be focusing on budget announcements. Apart from that, I have picked up a number of practice questions which will test your knowledge of both static part as well as the budget announcements, so that you get that holistic understanding related to public finance. So let's start our discussion now. You can see here, these are the questions related to important provisions of the budget. Questions have been asked with respect to revenue and capital account, with respect to expenditure of the government, with respect to consolidated fund of India, interim budget, FRBM Act. Twice questions have been asked, and one question related to tax evasion. So let's take up first some questions related to provisions of the budget. Look at this question about Consolidated Fund of India. What is this Consolidated Fund of India? Article 266 of the Indian Constitution provides that whatever money the government gets through tax and non-tax revenue, borrowings, as well as recovery of loans. Three things. That is tax and non-tax revenue, borrowings of the government, as well as recovery of loans. All of that money should get credited into Consolidated Fund of India. And if the government wants to withdraw money from CFI, the government would need prior approval of the parliament. But what you must understand is, sometimes, people also deposit money with the government as a matter of trust. Example being, you must have heard of small savings schemes which the public maintain with the government. Small savings schemes such as post office deposits, Kisan Vikas Patra, National Savings Certificate, Sukanya Samriddhi account. All of these deposits which the public maintain with the government do not form part of Consolidated Fund of India. Rather, they form part of public account of India. So based upon this knowledge, let's solve this question. Surcharge and cess will get credited into CFI. Borrowings of the center will get credited into CFI. But what you must understand is, if the state government is borrowing money, that will not go into Consolidated Fund of India. Rather, it will go into Consolidated Fund of a state. That is why the second one is incorrect. Transfer of dividend, it's a non-tax revenue. It is correct. Post office deposits, it goes into public account of India. So the right answer in this case should be 1 and 3. So right answer is B. Next one is with respect to Contingency Fund of India. See, as I discussed, if the government wants to withdraw money from CFI, government would need prior approval of the parliament. It may so happen that the government wants to withdraw money for certain emergency purposes, but the parliament might not be in session. So, in order to enable the government to spend money during some emergency situations, Article 267 of the Indian Constitution provides that Parliament through a law can set up Contingency Fund of India Act. So this is what is mentioned in the Constitution. So what you must know is, Constitution does not set up Contingency Fund of India. Rather, the Constitution calls upon the Parliament to make a law to set up Contingency Fund of India. The corpus of this contingency fund now stands at rupees 30,000 crores. This fund is placed at the disposal of the president. And as far as the approval from this particular, as far as withdrawal of money is concerned, the approval is ex post facto approval. It means the government will first spend money from Contingency Fund of India. After spending money, it will take the approval of the parliament. So that way, if you read the first statement, it says the fund has been established by the Indian Constitution. Obviously not, because the Indian Constitution requires a parliament to make a law to establish the contingency fund. It is placed at the disposal of president. It is right. The corpus of the fund is 500 crores. No, like I said, it is 30,000 crores. Answer is 2 only. With respect to demand for grants, in your polity, you must have studied that every ministry or department will submit demand for grant before the parliament. The demand for grant will carry details such as how much particular money the ministry would need for the next financial year, and where would it spend this particular money. That is demand for grant. It is presented before the parliament. Generally what happens is one ministry will present one demand for grant. These demand for grants are put to vote only in Lok Sabha, not in Rajya Sabha. And when they are put to vote, you have different types of cut motion. Like you have the token cut, economic cut. So these kind of cut motions can be moved in the Lok Sabha. Apart from that, you must also understand that demand for grants, generally one ministry will present one demand for grant. However, if the ministry is quite big, it can present in fact 2 to 3 demand for grants also. So if you see the first statement, every ministry or department can present only one demand for grant, it is incorrect. The demand for grant will include the expenditure which is voted upon by Lok Sabha and the expenditure which is charged upon the consolidated fund of India. To ensure the independence and autonomy of some of the important constitutional offices like the Supreme Court, the UPSC, etc., we have an expenditure which is called as expenditure charged upon the consolidated fund of India. With respect to this expenditure, discussion can take place in Lok Sabha, but there is no voting which would take place, right? What you should know is demand for grant will include both. That is the expenditure which is voted upon as well as the expenditure which is charged upon. The voting will take place only on the demand which is to be voted upon. Voting will not take place upon the demand which is charged upon the consolidated fund of India. At most, discussion can take place in the parliament. So the second statement here is right. So answer is 2 only. Which among the following funds are part of public account of India? So if you carefully look into public account of India, one is obviously the deposits which the public will maintain with the government. That is small saving schemes. All of that money will go into National Small Savings Fund. Apart from that, most of you must be knowing about the concept of cess. Cess is a special kind of tax which is imposed for a specific cause, for a specific reason. Whatever cess the government collects, all of that money initially goes into CFI, that is Consolidated Fund of India. Later, with the approval of the parliament, from CFI it goes into public account of India. Within the public account of India, it will be maintained in a separate fund, simply to ensure that the money is spent for a specific cause. Example, the education cess which the government collects on income tax goes into CFI, and from CFI it goes into public account of India. In public account of India, it will be part of funds like Prarambhik Shiksha Kosh, Madhyamik Shiksha Kosh, Uchchatar Shiksha Kosh, which as a name itself makes us understand that it is a fund which is set aside for primary, secondary and tertiary education. So, in the public account of India, you would have NDRF also, National Investment Fund also. So, whenever the government undertakes disinvestment, right, that disinvestment proceeds goes into NIF, and even the GST compensation fund, which is imposed to compensate the states for the loss in their revenue. So answer is 1, 2, 3 and 4. So because in previous year prelims, questions are asked with respect to basic aspects of Consolidated Fund of India, I have taken up this particular discussion. Further, for your understanding, I have incorporated the details of CFI, contingency fund, public account, as well as the documents which are mandated by the constitution, documents mandated by FRBM Act, as well as documents mandated due to parliamentary convention. So having discussed the basics related to budget, let's now get into the actual discussion of the budget. That is, what is the present state of public finances? Okay. See, when you look at annual financial statement provides the details of receipts and expenditure for 3 financial years. That is, for the previous financial year, it gives the actual receipts and expenditure. For the present financial year, it gives the details of revised estimates of receipts and expenditure. And for the next financial year, it gives the details of budgetary estimates. So, annual financial statement does not give details of just one financial year. Rather, it gives details of 3 financial years. You must be having a doubt. In UPSC prelims, what should I focus upon? Previous financial year, present financial year, or the next financial year? For UPSC prelims, you need to focus on the present financial year. So accordingly, whatever I'm going to discuss with respect to state of public finance, I'm not discussing for the previous financial year or the future financial year. I'm talking about the present financial year, which is 24-25. So that way, if you see the total budget size for 24-25, it is 47 lakh crores. This is the total budget size. What do you mean by budget size of 47 lakh crore? It basically means that our total receipts, including borrowings, is 47 lakh crore, and our total expenditure is also 47 lakh crores. That is the budget size. So in India, the budget is said to be balanced budget. Why it is balanced? It is balanced because our total receipts is always equal to expenditure. Some of you must be thinking, how is it possible that the budget is balanced? Because our expenditure is always more than the receipts, right? The reason is very simple. Think of this example. Let's say we are spending 125 rupees. Our expenditure is 125 and our receipts is 100. It means there's a gap of how much rupees? 25 rupees. So what will the government do? Government will borrow 25 rupees. That 25 rupees, it will account it as part of capital receipts. By showing it as part of capital receipts, the total receipts, including borrowings, would become 100 plus 25 and our expenditure is 125. So total receipts and expenditure both will match. That is why the budget is considered to be a balanced budget. For example, if you see, our total revenue receipts is 31 lakh crore and capital receipts is 16 lakh crore. So you can add up the numbers. 31 plus 16 is 47. Receipts is 47. Including what? Including our borrowings. And where are borrowings accounted? Capital receipts. Expenditure, if you see, RE is 37 lakh crore and CE, that is capital expenditure, is 10 lakh crore. 37 plus 10 is 47 lakh crores. So let's concentrate on the revenue receipts first. Within the revenue receipts, you may have already studied that revenue receipts will include your tax revenue, non-tax revenue, which is interest receipts, dividends of PSUs, user charges, grants in aid, non-tax revenue of union territories. All of this together constitute your revenue receipts. So if you look at the gross tax revenue, what is the total tax collected by the government? That is the central government. The gross tax revenue of the central government for the year 24-25 is 38.5 lakh crores. That's a total gross tax revenue. But you know that whatever tax the central government collects, some percentage of these taxes, they are transferred to the states based upon the recommendations of the Finance Commission. Apart from that, some amount of tax which the central government collects, it will transfer to NDRF, National Disaster Response Fund. So this is your gross tax revenue. That is the total revenue collected by the center. From here, the central government is transferring some amount of share of the taxes to states, some amount of money to NDRF. So if you deduct these two from the gross tax revenue, you will be left with net tax revenue of the central government. So you can see net tax revenue is gross tax revenue minus state share of taxes plus transfer to NDRF. This net tax revenue of the government is 25.5 lakh crores. So if you see components, net tax revenue is 25.5, which means the remaining non-tax revenue will add up to 31 lakh crores. Next one is tax to GDP ratio. So before looking into what is India's tax to GDP ratio, I just want to tell you two things. First thing is, when we say tax here, please understand, we are not referring to net tax revenue. Rather, we are referring to gross tax revenue. And how much is our gross tax revenue? 38.5 lakh crore. That is our gross tax revenue. And second thing is, when you see the GDP here, you know that GDP is calculated either as real GDP, that is GDP at base year price, or GDP might also be calculated as nominal GDP, that is GDP at current year prices, right? So the GDP that we are talking about is not the real GDP. Rather, it is the nominal GDP. And nominal GDP of India for the year 24-25, for this year, present year, this is around 324 lakh crores. That will give us what is tax to GDP ratio. So if you do a simple maths, that is 38.5 divided by 324, the value that you will get is somewhere around 11.9%. That is our tax to GDP ratio. And you know, there are two types of taxes, that is direct taxes and indirect taxes. For the present financial year, the share of direct taxes is more than that of indirect taxes. So you can see the share of direct taxes is 6.9 and the indirect taxes is 5. Apart from that, if you arrange the taxes in the descending order, the tax which accounts for the highest share for the central government is income tax, GST, corporate tax, excise duty, and customs duty. There's one thing which I want to tell you. See, when we say GST, right? GST, as you know, includes the GST which is collected by the center and the GST which is collected by the states. The GST which is collected by the center includes central GST as well as GST compensation cess. The GST collected by the states include the state GST. So here, when I'm saying decreasing order of taxes for the central government with respect to GST, I'm discussing from the perspective of the GST which is collected only by the center. We don't include the GST which is collected by the states. That is, we don't include the state GST. So we will include central GST plus GST compensation cess. So if you add these two values, that value is lower than income tax but higher than corporate tax. With respect to revenue expenditure is basically maintenance related expenditure of the government, which includes interest payments, subsidies, defense, public administration, plus the grants which the center gives to the states for the creation of assets. All of this forms RE, revenue expenditure. Among these components, the component which accounts for the highest expenditure is interest payments. What is this interest payment, by the way? See, if you see fiscal deficit, it tells us how much money the government has borrowed for 1 year. Whereas debt tells us what is the total accumulated borrowing of the government. That is how much money the government has borrowed so far and has not repaid yet. Fiscal deficit of the government for the present year is somewhere around 15.5 lakh crore. This is what the government has borrowed for the present financial year. But when you look at debt, total accumulated borrowings of the government, this is somewhere around 180 lakh crores, which in terms of GDP is somewhere around 58%, about which we will be covering. So when the government has borrowed so much amount of money, government would have to pay interest on that, right? And can you see the interest burden of the government? The interest burden is almost 11 lakh crores. And that is followed by subsidies. With respect to subsidies, there are two major subsidies. One is food subsidy, which is basically the food grains which are provided through network of fair price shops, PDS, which alone accounts for almost 2 lakh crore, and that is followed by fertilizer subsidy, which is around 1.7 lakh crore. The numbers are not really important, but the trends are important. That is, which one is highest and which one is lowest. With respect to capital account receipts, capital receipts would include the debt receipts, that is the borrowings of the government, and the non-debt receipts. Non-debt receipts means these are the receipts of the government which do not increase the liability of the government. The government may have got the money through sale of its assets. For example, disinvestment, monetization of assets, that is sale of land, buildings, etc., or recovery of loans. And can you see here that our borrowings is somewhere like 15.2 lakh crore. Total capital account receipts is 16 lakh crore, out of which borrowings itself is 15.2 lakh crore. So remaining, I would say 70 to 80 is from non-debt receipts like disinvestment, monetization of assets, or recovery of loans. With respect to capital expenditure, the capital expenditure includes the money which is used to create new assets or the loans given to the states or UTs. So that is the overall state of public finance. Apart from that, let's look at the defense expenditure also. So if you see the defense expenditure of the government for the next financial year, I'm not saying for the present financial year, for the next financial year, the defense expenditure is estimated to be somewhere around 6 lakh crores. Out of that 6 lakh crores, can you see the breakup? The revenue expenditure is around 4.5 lakh crore. What can be the revenue expenditure in defense? It is like salaries and pensions of defense officials, maintenance of border, right? So that is somewhere around 4.5 lakh crore. But the capital expenditure on defense, that is around 1.5 lakh crores. Second, if you arrange all these receipts and expenditure in the descending order, you'll get to know the highest one is revenue expenditure, followed by revenue receipts, followed by capital receipts, and last one is capital expenditure. You'll understand why I have discussed this later when I show you the practice questions. So this is the present state of public finance. Now, let's look at the trend in government receipts, especially with respect to tax receipts. You can just have a look at this particular chart, which shows the trend in the government tax receipts, right from 2016-17 to 25-26. And like I said, for your prelims examination, you would have to focus on the revised estimates of the present financial year. The yellow color shows the share of direct taxes. Green color shows the share of indirect taxes. If you see the overall tax to GDP ratio, as discussed for the present year, it is around 11.9% for the present financial year. And we also discussed how it is calculated. Gross tax revenue divided by nominal GDP of India, right? If you see the trends in the tax to GDP ratio, there has been fluctuations in the overall tax to GDP ratio. But last year, that is in 23-24, the Central Board of Direct Taxes had published a report. In its report, CBDT had highlighted that direct tax to GDP ratio had increased to 24-year high of 6.6% in the previous financial year. That is, if you compare direct tax to GDP ratio of India right from 2001 to 23-24, we collected the highest direct tax to GDP ratio, which was 6.6%. Now, what is interesting here is for the present financial year, the direct tax to GDP ratio is expected. Why am I saying expected? Because the present financial year has not ended. The present financial year would end on March 31st. So by end of March 31st, it is expected that direct tax to GDP ratio would increase to 6.9%. And can you see the 6.9% for the present financial year is higher than the previous financial year tax to GDP ratio of 6.6%. So if you are able to meet this particular estimate, direct tax to GDP ratio in the present financial year is going to increase to 25-year high. This becomes an important trend from the perspective of your prelims examination, that is with respect to direct tax to GDP ratio. Apart from that, if you look at the yellow and green, yellow which highlights direct taxes, green which highlights the indirect taxes, generally in India, the share of direct taxes is more than the indirect taxes, barring 2 years in the recent past. These 2 years include 2016-17 and 2020-21. Barring these 2 years, generally the share of direct taxes is more than the indirect tax. Even this trend is quite important. Apart from that, please have a look at this. Here we covered trends in tax receipts of the central government. Here we are looking at the trends in the tax receipts of the general government. What is general government? General government means if you combine the finances of the center and states together, if you combine these two, what is the trend in tax to GDP ratio? Unfortunately, this trend is not given in this year's budget or economic survey. So I have to find a source, and the source here is National Institute of Public Finance and Policy. From this particular chart, we can very well see that tax to GDP ratio of the general government, that is center and state together, is somewhere around 17%, right? So if you see only of the central government, it is 11.9, that is 12. But center and states together, it is around 17%. But the problem here is since 2008-9, this tax to GDP ratio of center and states combined, that has remained stagnant, which is a very important trend for your prelims examination. Secondly, if you look at the share of direct taxes for both center and states combined, the share of direct taxes is somewhere around 6%. So the total tax to GDP ratio of general government is 17%, direct tax is 6%, so indirect tax is somewhere around 11%. So can you see one important factor coming into play here? For center, only for the center, the share of direct taxes is more than the indirect tax. But for the general government in India, center and states put together, share of indirect tax is more than the share of direct tax. So to make it more easier for you, so that you are able to remember for the prelims examination, I have prepared this particular table. You can see here I have highlighted the important parameters for the center and the general government, that is center and states combined. Highest tax for the center is income tax, but the highest tax for center and states combined, if you see, highest tax is GST. And here, when I'm referring to GST, I'm referring to the GST which is collected by both center as well as state. So this GST is central GST, GST compensation cess plus state GST. Decreasing out of taxes for the center, as we discussed, it is income tax, GST. There GST means central GST and GST compensation cess collected by the center. Corporate tax, excise duty, custom duty, but for the general government it is GST followed by income tax. Tax to GDP ratio for center is 12, 11.9. I have just rounded it off to 12. For the general government, it is 17%. Share of direct and indirect taxes, can you see for center, the share of direct taxes is more than the indirect taxes. But for the general government, the share of indirect taxes is more than the direct taxes. Now, some of you may have this particular doubt, or even if you're not having doubt, I'll put a doubt in your mind. Now, let's say there's a question in UPSC Prelims. Which among the following taxes account for the highest share in India? And let's say in that question, there are two options, income tax and GST. So your doubt should be, sir, which one should I choose? Should I choose income tax because it might be asking from the center? Or should I choose GST because it might be asking from the perspective of the general government? My response here is, if UPSC frames the question, it will try to ensure that the question is unambiguous, which means it will clearly mention for whom is it talking about. Like it might say, which among the following taxes account for the highest share in the union budget? Or which among the following taxes account for the highest share for the general government? Accordingly, for union government, choose income tax. For the general government, choose GST. So UPSC might mention the government which it wants to ask. Some of you might be thinking, what if UPSC does not ask explicitly? So what should we choose? Well, in that particular case, by default, assume that UPSC is asking about central or the union budget. So by default, if nothing is mentioned, always choose the finances of the center. That is what I have mentioned here in the form of students' doubt. If you get doubt, good enough. If you don't get doubt, you read this, get the doubt, and I have given my response also there. So having discussed about the finances of the both center and state, let's take up some practice questions here. The question is, which among the following best explains the concept of tax multiplier? Okay, let's understand what is this tax multiplier. See, if the government wants to increase the GDP, to increase GDP, government can adopt two methods, two approaches. One approach here is government may increase its expenditure. Particularly, government may spend more amount of money on creation of assets like roads, railways, ports, airports, and so on. If government is spending more amount of money on creation of assets, it will encourage private sector investment. It will crowd in private sector investment. It will lead to creation of more jobs. It will lead to increase in GDP. In fact, it is being said that for every 1 rupee spent by the government on creation of assets, the output can increase by rupees 2.5. So this concept where increase in expenditure leads to increase in GDP, this concept we call it as government expenditure multiplier. So can you see, 1 rupee you spent by the government leads to increase in output by 2.5. This is one way. The second way also. Second way here is government may reduce the tax rate, which government has done in this particular budget, where the government has increased the rebate as well as government has changed the tax slabs. So by changing or tweaking the tax, which has happened this time, the government can encourage more savings by the people as well as more spending by the people. So because of that, once again, the GDP might increase. So if people save money, those savings will be diverted towards investment. Increase in investment will lead to GDP. On the other hand, if government decided to spend money to purchase goods and services, consumption expenditure increases, even that will lead to increase in GDP. This concept wherein changes in tax rates leads to increase in GDP, we call this as tax multiplier. So there are two concepts, government expenditure multiplier and the second one is tax multiplier. So you can see until this year's budget, government was trying to increase the GDP through expenditure multiplier. But this year's budget, it is focused on the tax multiplier. That is why I have picked up this particular question. So if you read the options, the right answer here is change in GDP in response to change in tax rates. So that is the right answer. Let's look at the next practice question. Negative tax buoyancy in a year would necessarily indicate which among the following? What is tax buoyancy, by the way? A lot of students have a confusion here. So let's understand this. Tax buoyancy means percentage change in tax collection divided by percentage change in GDP. Which means, just for an example, let's say if GDP increases, we can say that the tax collection of the government also increases. How? For example, if GDP increases, it means that people's income level is increasing. If people income level increases, people will pay more income tax. This is from the perspective of direct tax. On the other hand, if GDP is increasing, it means that people are spending more money to purchase goods and services. So what will happen to GST collections? GST collections will increase. So let's say here that if GDP increases, for example, by 10% and tax collection also increases by 10%. Tax buoyancy is percentage change in tax collection divided by percentage change in GDP. 10 divided by 10, in this case, tax buoyancy will be equal to 1. On the other hand, if GDP increases by 10%, but tax collection increases by 20%, 20 divided by 10, tax buoyancy would be equal to 2. On the other hand, if GDP increases by 10% and if tax collection increases by just 5%, 5 divided by 10, tax buoyancy will be equal to 0.5. So ideally, tax buoyancy should be 1 or more than 1. It should not be less than 1. But the question is something else. The question says, what do you mean by negative tax buoyancy? Negative tax buoyancy means, see, there are two possibilities. Possibility number 1 is, it may have so happened that GDP has increased by 10%, but tax collection has reduced by 10%, minus 10. So in this case, the tax buoyancy will be percentage change in tax collection minus 10 divided by percentage change in GDP is plus 10. So this tax buoyancy will be equal to minus 1. Some of you might say, sir, even this is possible. That is scenario 2. Scenario 2, where it may have so happened that tax collection has increased by 10%, but GDP may have reduced by minus 10. So here also, percentage change in tax collection is plus 10 divided by percentage change in GDP is minus 10. Tax buoyancy should be minus 1. That is what you can argue. But one thing you must understand, if GDP does not increase, if there is negative GDP growth, in that particular case, tax buoyancy is not calculated, which means in the second scenario, I will not calculate tax buoyancy. Tax buoyancy is calculated only when there is increase in GDP. When do you think this must have happened in India? Obviously during COVID, because during COVID there was a contraction in our GDP, so we did not calculate tax buoyancy. So you can see here, negative tax buoyancy means there is decrease in tax collection in spite of increase in GDP growth rate. That is what is negative tax buoyancy. Practice MCQ number 7. Direct tax to GDP ratio has reached its highest level in the last 24 years in 23-24. Obviously, it is right. Direct tax buoyancy has reached its highest level in the last 24 years. Unfortunately, our tax buoyancy has not reached its highest level in the last 24 years. Only the tax to GDP ratio has increased to its highest level in last 24 years. So the statement 2 is incorrect. So the right answer is C. Statement 1 is correct, but statement 2 is incorrect. Consider following statements with respect to finances of the general government. This is how UPSC would ask. General government means center and states combined. The income tax account for the highest share of taxes? No, it is actually GST. The share of indirect taxes is higher than the share of direct taxes, which is right. So right answer is 2 only. And look at this question. Now this was a question which was asked in Karnataka Public Service Commission of 2024 KPSC exam. Arrange the following items with respect to union budget in India in the descending order. Descending order, if you see, we discuss it is revenue expenditure, followed by revenue receipts, followed by capital receipts, followed by capital expenditure. So answer should be A, C, D, B. So this is a right answer. That's why I said I have discussed this in the context of the union budget as well. Apart from that, what I also want to tell you is in the budget, there's a Finance Act. This Finance Act generally incorporates some changes to the taxation. For example, if the government is tweaking, let's say income tax, corporate tax, or if the government wants to introduce a new tax, generally such proposals related to changes in taxes are incorporated in the Finance Act. And if you carefully analyze the previous year questions, at least twice questions are directly asked from the Finance Acts of the respective year. For example, in Prelims 2023, there was a question related to the tax liability of InvITs. Now, this was incorporated in the Finance Act of 2021. From there, the UPSC has asked this particular question. So generally, there are so many changes in Finance Act and we tend to ignore them. And that is what UPSC has picked up, something which we ignore. And on that, UPSC has asked a question. Not just this, in Prelims 2018, there was a question related to equalization levy. Read the first statement. It is introduced as part of Income Tax Act. This statement was incorrect because equalization levy was not introduced as part of Income Tax Act. It was introduced as part of Finance Act. So, because questions are generally asked from Finance Act, that is important proposals related to taxation. What I've done is I've gone through this year's Finance Act, and after going through, I have picked up some important changes in the tax collection. And that is what I'm going to discuss one by one. So let's start with obviously the most important development in this year's budget, that is with respect to income tax. So let's see what changes have taken place in the income tax and how these changes is going to affect the middle class in India. So you can see that is a earlier tax slab, income tax slab, and this is the present tax slab. That is a new tax slab introduced by the finance minister. So let's understand as to in what way the new tax regime is different from the earlier regime. The first change, as you can see, earlier the threshold for paying income tax was 3 lakhs and above. But now that threshold for paying income tax has been increased to 4 lakh. That is the first important change. Second important change is, earlier we did not have a tax rate of 25%, but now we have introduced a new tax rate of 25%. Third, earlier the highest tax slab of 30%, this was applicable to the people whose income was more than 15 lakh. But now the highest tax slab of 30% is applicable to the people whose income is more than 24 lakh. So obviously it is a big benefit for the middle class. Apart from that, we have a concept of tax rebate. What is the meaning of tax rebate? Tax rebate means in case if you are paid tax, whatever tax that you are paid, entire tax would be refunded. That is what is tax rebate. Earlier, if your income was up to rupees 7 lakh, and in case if you are paid some tax to the government, entire tax was refunded, which means there's no tax burden. There was no tax burden on the people who are earning up to rupees 7 lakh. Now, the tax rebate has been extended to the people who are earning up to rupees 12 lakh. So imagine there's a person who was earlier earning, let's say 12 lakh. That person used to pay income tax. But now the same person who is earning up to 12 lakh, if he pays income tax, entire tax will get refunded, tax rebate, right? So obviously the tax burden has reduced. Apart from that, in India, we have a concept of standard deduction. What is standard deduction? Standard deduction means whatever is your taxable income, from that taxable income, you could deduct some amount. After deducting some amount, for which you don't have to give any necessary details to the government, you could deduct some amount, and whatever is the remaining amount, on that remaining amount, you could pay the tax. That is what is standard deduction. Until last year, the standard deduction was 50,000. So if my income is, let's say, around 10 lakh, I will deduct 50,000 from my 10 lakh. So my taxable income will become 9.5 lakh. And I will pay tax only on 9.5 lakh and not on 10 lakh. Last year's budget, the standard deduction was increased from 50,000 to 75,000. This happened in last year's budget. Which means now, think of an individual who is earning 12.75 lakh. If he is earning 12.75 lakh, he can claim a standard deduction of 75,000. So his taxable income will become 12 lakh, and up to 12 lakh he can get a tax rebate, right? So in a way, it is not just people who are earning 12 lakh, it is also people who are earning up to 12.75. They are going to get benefit. But there's one important thing which I would want you to understand. In India, there are two tax regimes. Old tax regime and new tax regime. What's the difference here? Under the old tax regime, when people pay income tax, they can claim number of tax exemptions, or they can claim number of tax deductions, obviously apart from standard deduction. What kind of exemptions or deductions? For example, people can claim exemptions on their premium which they pay for life insurance, on their provident fund, on their investment in small saving schemes, donations, right? So on that, they can claim tax exemptions or tax benefits. But under the new tax, there are no exemptions. There are no exemptions now. So you have to pay tax according to your taxable income without availing any kind of tax exemption. So which means if you are a taxpayer, you are required to choose whether you want to pay tax by claiming exemptions and deductions under the old tax regime, or you don't want to claim any tax exemptions or tax deductions and you want to pay tax under the new tax regime. So choice is up to the people. But the new tax regime has now become the default tax regime. What do you mean by default tax regime? It means if you don't inform the government which regime you want to follow, by default, government would consider that you have adopted the new tax regime, wherein you will not be claiming any kind of tax exemptions and deductions except the standard deduction. Obviously, standard deduction is there in the new tax regime. Whatever changes that I've discussed, please understand those changes are not applicable for the old tax regime. Old tax regime has continued to be in a same manner as it used to exist before. The changes which I have discussed, they are only for the new tax regime. That is what I have mentioned. Apart from that, tax rebate, you will get it only, I repeat, only if your annual income is 12 lakh or below. If your annual income is 13 lakh, 14 lakh, there is no tax rebate at all. Some of you might find it confusing. That is why I have incorporated some examples to make you understand what do you mean by not claiming tax rebate if your income is more than 12 lakh. Let's understand that through an example. Please see this here. Let's say there's a person who is earning to 12 lakh. Let's say under the earlier tax regime, which means before this regime has come into play, how much tax he would pay. So if a person is earning up to 12 lakh, what actually happens is how people pay income tax. If some of you don't know, for his income between 0 to 3 lakh, he will not pay any tax. For his income between 3 to 7 lakh, which is how much? 3 to 7, 4, 5, 6, 7, which is 4 lakh. On that 4 lakh income, he has to pay 5% tax. So 5% of 4 lakh is 20,000. For his income from 7 to 10 lakh, he will pay 10%. So 10% of 3 lakh, he'll pay 30,000. 10 to 12 lakh, which is for 2 lakh, he'll pay 15%. 15% of 2 lakh is 30,000. So his income is 12 lakh, right? So based upon that, according to existing tax slab, he'll pay the total tax of 80,000. That is how income tax is paid. So understand, income tax is not paid at a flat rate. Like you should not think ki if your income is 12 lakh, you'll pay 15% of 12 lakh. This is not how it works. Now, in the new tax regime, no tax is payable as a tax rebate is provided on the income of up to rupees 12 lakh. So under the new tax regime, a person is getting a benefit of 80,000 rupees. Let's talk about a person whose income is more than 12 lakh. That is where the confusion was. Let's see here. If a person is earning income of up to 18 lakh, in that case, what will happen? According to earlier tax slab, I have already worked out the maths. You can just go to that part later. According to earlier tax slab, the person was liable to pay total income of 2.3 lakh. But in the new tax slab, you must understand his income is more than 12 lakh. No? So because his income is more than 12 lakh, there is no rebate for this person. It means for his income up to 12 lakh, he has to pay this tax. He cannot claim rebate on that. That is what I mentioned here. Tax rebate is not available if income is more than 12 lakh. So the total tax liable to be paid by this individual is 1.6 lakh. Under the earlier regime, the person was paying 2.3 lakh. Now he is paying 1.6 lakh. So the person is getting a benefit of 70,000. That is what is the tax rebate. That is how people are going to get benefited. I hope everyone has understood this concept of income tax regime, right? The next topic is with respect to securities transaction tax. Recently, it was reported in various newspapers that despite large-scale volatility in our capital market, STT collections have increased by almost 75%. Like I pointed out earlier, UPSC generally asks questions on taxes which are in news. So which tax is in news? STT, Securities Transaction Tax. So all the details related to securities transaction tax, I have covered it in one of the current affairs class recently in the month of Jan. So what I will do, in the description box below, I'll provide you the link to this particular video on securities transaction tax. Please watch that particular video. In that video, I've covered everything related to STT. After watching the video, you can try attempting these two practice questions also. So let's move on to the next thing from Finance Act. Okay, now this is what is most interesting. In this year's budget, mostly the focus has been on changes in income tax slab, rightly so. But apart from changes in income tax slab, something else has significantly happened. That is with respect to rationalization of customs duty. So this actually has not got so much of limelight as income tax. So what we are going to do now is we are going to get into the discussion of the rationalization of customs duty, which was done in this year's budget. So after discussing all of this, we'll be taking up these three practice questions also. And you need not worry, whatever I am discussing in the next, say, 10 minutes, everything is there in the form of a mind map. So I'm just writing it and making you understand so that you get more clarity with respect to customs duty rationalization. So in India, whenever we import goods, on import of goods, we impose different taxes. For example, we will impose basic customs duty. And this basic customs duty is imposed as percentage of the value of the product. Now, for example, let's say the basic custom duty is 5% and the value of the product is 100 rupees. So custom duty which is to be paid by an importer would be rupees 5. So importer will pay 100 rupees for the product plus 5 rupees as custom duty, which means the total money the importer would pay is 105. Apart from basic customs duty, the next tax is IGST, which is integrated GST. What is integrated GST? Integrated GST is a GST which is imposed on interstate supply of goods as well as on import of goods. So if you import some goods from other country, that is actually considered as interstate supply. And on import of goods, the importer would be required to pay integrated GST. And please understand, the IGST rate would be same as GST rate in India. And what is this IGST rate same as GST rate? For example, in India, if you purchase a mobile phone, let's say GST rate which is specified by GST Council is 18%. IGST rate on import of mobile phone would also be 18%. Let's say milk. If you purchase milk in India, for example, let's say you pay a GST of 5%. Same way, if you import milk, you would be required to pay a IGST and that IGST rate would be 5%. That is what is IGST rate is same as GST rate. And this IGST is imposed as percentage, that is whatever is the rate of the value of the product plus basic customs duty. Look at this example. Say the value of product is 100, basic custom duty is 5, and let's say the GST rate is, for example, 18%. So the importer would be required to pay 18% of 105 as IGST. But if you know about the working mechanism of GST, please understand that if IGST is paid, they can claim input tax credit. And discussing input tax credit is beyond the scope of this discussion, right? So please understand that if someone pays for IGST, they can claim input tax credit. Apart from this, there is Agriculture Infrastructure Development Cess. Agriculture Infrastructure Development Cess is imposed on import of certain specified commodities such as gold, silver, alcohol, coal, etc. And this Agriculture Infrastructure Development says it is imposed as percentage of value of the product. So because it is a cess, whatever money the government collects, that money the government will use it only for the development of infrastructure in agriculture, which can be construction of godowns, modernization of APMC, mandis, and so on. Apart from that, there is also social welfare surcharge, and this once again is imposed on certain specified commodities, and these commodities are notified by the government. So can you see, on import of goods into India, there is basic customs duty, integrated GST, agriculture, infrastructure and development cess, and social welfare surcharge. Now, what is the importance of customs duty? Why are we imposing the custom duty? Obviously, one, I can say it is a source of revenue for the government, right? You can very well see this money, the government can use it for development of infrastructure in agriculture. This money, social welfare surcharge, the government can use it for providing education, health, and so on. And basic custom duty can also be a source of revenue. Apart from source of revenue, this custom duties are also used for protection of domestic industry. So generally what will happen is, if the custom duty is very less, there will be cheaper foreign goods entering into Indian domestic market. Entry of cheaper foreign goods into Indian domestic market will have an adverse effect on our domestic manufacturing. So to protect our domestic manufacturing, we can increase the customs duty. For example, on import of luxury cars, import of luxury bikes, the customs duty in India is somewhere around 100%. The idea is to protect our domestic industry. Apart from that, you must also understand customs duty in a way help India to achieve the vision of Atmanirbhar Bharat. What is Atmanirbhar Bharat? Atmanirbhar Bharat is basically India which is self-sufficient and resilient. When I say self-sufficient India, means India which is not dependent upon imports. And how do you reduce imports? By increasing the custom duty and encouraging the domestic manufacturing. So this is a very important tool for India to become Atmanirbhar. Let me just give an example. The best example where higher customs duty have helped to promote our domestic manufacturing is toys. So until few years, India was a net importer of toys. Most of the toys that we were importing were from China. And we started increasing the custom duty on the toys. By increasing the custom duty on the toys, we gave a thrust to our domestic manufacturing of toys. And within few years, India has now become a net exporter of toys. This was possible because of the customs duty, right? But it is being said that there are number of problems with respect to customs duty in India. What are the problems in the custom duty? For that, let me just give you an example from GST so that you are able to correlate to custom duty. Before introduction of GST, remember we used to have multiple indirect tax rates. I'm not talking about indirect taxes, I'm talking about tax rates. For example, we used to have tax rate of 0, 1, 2, 4, 5. So we used to have multiplicity of tax rates. Because of multiplicity in tax rate, the overall indirect tax regime was very complicated to administer. So what we did, all of these indirect taxes, we subsumed into one single tax, which is GST. And within GST, we have ensured that there are just 4 standard tax rates, which include 5, 12, 18, and 28. This is what we have done in GST. So GST is not just subsuming multiple indirect taxes. GST is also about rationalization of tax rates. Same logic, when you see customs duty in India, the problem with customs duty is, according to an institute called as Global Trade Research Institute, according to this, we have at least 40 different custom duty rates. And these rates range from 0% to almost 150%. So just like earlier indirect tax regime, we used to have multiple tax rate leading to complexity. Same thing, when we have so many custom duty rates, it leads to increase in complexity. That is the most important problem as far as the customs duty is concerned. Apart from that, before the introduction of GST, you know that one of the problem that we used to have in India was cascading effect of tax on tax. Cascading effect of tax on tax means on one tax we used to impose other tax. Can I say the same thing is happening in custom duty also? How? For example, you are paying custom duty. On top of custom duty, you have IGST. And in certain cases, you'll also pay agriculture, infrastructure development cess. And in some cases, even this one gets added. So there can be certain products on which you have basic custom duty, agriculture, infrastructure and development cess plus social welfare surcharge, which leads to cascading effect of tax on tax. So that is another problem with respect to customs duty, which is cascading effect of tax on tax. So we need to get rid of this particular problem on customs duty. The third one, and quite interesting, it is being said that in India, the average tariff is somewhere around 11.6%. So we have multiple tax rates, right? Ranging from 0 to 150. But the average tax rate on import of goods into India is 11.6%. If you compare other countries, as compared to other countries, in India, the average tax rate is considered to be higher. Example being, in US, it is somewhere like 3 to 5%. In China, it is somewhere like 8%. So as compared to other countries, the tax rates, the import duty rates are high. But why is it a problem? It should be good because it can help us protect our domestic industry, right? The problem here is excessive protection of domestic industries is also a problem. If you give too much protection to our domestic industry from import of cheaper foreign goods, the domestic industries might become complacent. the domestic industries might not focus on manufacturing of world class goods because they're not facing the competition from foreign goods. In fact, can I say the same thing happened in the pre 1991 era when Indian economy was characterized by protectionism. So it is being said excessive protectionism is as bad as free market. So India has to find a right balance between protection and excessive protection. So we have to find a right balance. That is where it is being said that we have to reduce the customs duty. That's the first thing. Second thing, as you know, India wants to replace China because of China plus one strategy. We want to encourage more foreign companies to come and invest in India. These foreign companies should be able to import raw materials and other goods from other countries. To enable that to happen, the custom duty rate should be lower. So there is a need for lowering custom duty because excessive protectionism will hinder, let's say, competition in the economy. Apart from that, excessive protectionism will in a way will not help India to get integrated into global value chains. Fourth is also about optics. Let me explain this in detail. What is this optics? It is being said that on most of the goods that India imports, the tariff is quite lower. In fact, on most of the goods that we import into India, the customs duty rate could be like 5%, 10%, 15%, 20%. The tariff is quite lower. But if you see, higher tariff exists only on few goods. In fact, according to GTRI, that is Global Trade Research Institute, it has highlighted that the tariff rate of 100%, 125%, 150%, it is applicable on just 5 goods in India. And which are these goods? It could be motorcycles, bikes, it could be cars, it could be alcoholic beverages, and so on. Now, why it is bad optics? Bad optics because if you see all other countries, including US, that is Trump, where are they focusing? They are focusing on this, saying that India has high tariff. But what they are overlooking is on most of the goods, the tariff in India is quite lower. This is being overlooked, and there is excessive focus on just, let's say, 5 goods on which the tariff rate is higher. It gives a negative image of India as a tariff king, as highlighted by Trump. So that is why it is being said we need to correct this optics also, right? So because we are having all these problems, in this year's budget, the finance minister has decided to undertake rationalization of customs duty. What are these rationalization? Let's understand them by looking at the budget announcements. So you can see multiplicity in tax rates, average higher tariff rates, bad optics, we covered that. Okay, then there is inverted duty structure. What is this inverted duty structure? See, in an ideal scenario, if this is India, if you are importing finished goods or if you are importing raw materials, on both of these two, we would impose customs duty on both import of raw material and import of finished goods. Ideally, customs duty on finished goods should be higher than customs duty on raw material. The reason is very simple. Higher customs duty on finished good will discourage import of finished goods. Lower custom duty on raw material will encourage import of raw material which will help us in domestic manufacturing. Ideally, this should be the scenario. But in case of inverted duty structure, the problem which arises is the customs duty on raw materials will be more than the custom duty on finished goods. It means it will encourage domestic industries or consumers in India to import cheaper finished goods as compared to the raw materials. That is what is inverted duty structure. This is another problem. So all of these problems have been rectified to a certain extent in this year's budget. Like the number of custom duty rates on industrial goods have got reduced from 15 to 8. What is important to be noted here is, because agriculture is a very sensitive subject for the Indian economy, the finance minister has not touched the customs duty on agricultural commodities. They have continued to remain same. We have reduced the customs duty or rationalized the custom duty only on industrial goods. The peak customs duty, like we said, the custom duty in India ranges from 0 to 150%. So the highest custom duty earlier used to be 150%. From 150%, now we have brought it down to 70%. For example, Trump has been demanding that the tax rate on import of Harley Davidson bikes should be reduced, right? So accordingly, what we have done, tax rate on motorcycles, which was like 100%, now it has come down to 70%. Application of surcharge and cess. So earlier the problem was we used to have cascading effect of tax on tax. This to a certain extent has been rectified, wherein the finance minister has highlighted that at most we will impose only one surcharge or cess. We will not impose multiple cess and surcharge simultaneously on a particular product. Decrease in average customs duty. So I told you average custom duty is like 11.65. So from 11.65 it has come down to 10.66% because of this rationalization. In different sources, different average custom duty is mentioned. So I have gone by the official source, that is CBIC chairman. So according to him, this is a decrease in average custom duty rate, and you can quote this in the exam as well. Now what is interesting is, on most of the products we have reduced the custom duty, but on certain selected products what we have done is we have reduced the custom duty, but this reduction in custom duty is compensated by increasing the agriculture, infrastructure and development cess, or let's say surcharge. So the basic custom duty might have got reduced, but cess rate has got increased, which means the tax rate as such is going to remain same. So it might not lead to revenue loss on certain selected products. But the problem here is, if basic custom duty is reduced and cess rate is increased, it is that the state share of taxes will reduce, because states get a share of basic custom duty, they don't get a share of cess, right? So this is a problem which might arise. And finance minister has declared zero custom duty on certain life-saving drugs and medicines. So let's take up the questions here. Which among the following taxes are imposed on import of goods into India? Integrated GST, agriculture, infrastructure and development cess, social welfare surcharge, even health cess is imposed on import of medical devices. So even this is correct. So right answer is 1, 2, 3 and 4. With respect to agriculture, infrastructure and development cess, consider the following statements. It is imposed on import of agricultural commodities into India. There are certain agricultural commodities on which this cess is imposed, but it is not just imposed on agricultural commodities, right? So it is incorrect. The proceeds is used to develop agricultural infrastructure, is right. Unlike other cess, the proceeds is shared with the states. Absolutely not. So right answer is 2 only. Last one, which among the following best describes the concept of inverted duty structure? So you can look at the options. The right answer in this is scenario wherein customs duty on raw materials is higher than the customs duty on the finished goods. Now coming to the next topic, that is with respect to rationalization of TDS, that is tax deducted at source, and TCS, that is tax collected at source. So before discussing what exactly is TDS and TCS, let me just tell you as to how income tax or tax in general is paid in India. Generally, what happens is at the end of the financial year, the people are required to add all their income. By adding all the income, which includes the income from salary, income from rent, income in the form of interest income on deposits, interest income on bonds, and so on, by adding all of that income, they'll get the taxable income. They have to declare to the government voluntarily that this is what is their taxable income. And based upon the tax slab a particular person would belong to, such a person will be required to pay income tax accordingly. That is how income tax is, paid in India. It means it is based upon the voluntary disclosure of the people as to when they declare their taxable income. But there's a problem here. The problem here is there might be some people who voluntarily might not disclose their true taxable income. For example, they may deliberately show less taxable income. So obviously, it might lead to tax evasion. So the tax collections of the government would reduce. Take for example, there might be a particular person who might be earning income from rent, income in the form of interest on deposit. Even though they are earning this income, they might not show it as part of their taxable income, and hence they might not pay tax to the government. So this will lead to tax evasion. So to check the tax evasion and to improve the tax collection, we do have a concept of tax deducted at source. Let's see how this tax deducted at source would work. Now, for example, let's say there is a particular entity. This entity could be a company or the government or a person. Say this entity is making payment. They are making payment for salary, let's say dividend to the shareholder, or interest on bonds or deposits, or let's say it is making payment for rent, payment to contractors, or let's say someone has won lottery, or someone has won a bet on that they are making some payment. Now look at the name, TDS, tax deducted at source. So when they are making the payment, right, they will not make the entire payment. Instead of making entire payment, they will deduct some amount as tax, and only the remaining amount is paid to the concerned person. Example, let's say a dividend of rupees 100 is to be paid to the shareholder, and government has said that the TDS rate, for example, on dividend to shareholders is 5%. So if the company is making payment of dividend to the shareholder, the company is required to deduct 5%, that is TDS, from rupees 100. So 5% of rupees 100 means the company will deduct 5 rupees from the dividend which is to be paid to the shareholder. So the company will not pay 100 rupees to the shareholder, rather the company would pay 95 rupees to the shareholder, and the remaining 5 rupees is then paid to the government. This 5 rupees, you can say that this is the tax which the company is paying to the government on behalf of the shareholder. This is an example of TDS. Same logic. Let's say someone wins a lottery worth, let's say 1 crore. And let's say the TDS is equal to 30%. So the lottery company, while making the payment to the lottery winner, will not pay entire 1 crore. It will deduct 30% of 1 crore, which is in this case 30 lakh, and pay only 70 lakh to the winner of the lottery. Remaining 30 lakh, the company would make payment to the government, tax payment to the government on behalf of the lottery winner. So this is the meaning of TDS. So you can see government has said, if the amount of payment that you are making is above some threshold level. For example, in case of rent, just an example, if on a yearly basis, if you are making a rent payment of rupees 2.4 lakh and above, if it is more than that, then the entity which is making payment is required to deduct certain percentage of payment. How much is that percentage? That will depend. The government will lay down. For example, for lottery, 30%, for dividend, 5%. So the percentage will range from 0.1 to 40% depending upon the nature of payment, and only the remaining money is paid to the government. Now what actually happens is the entity which is deducting the tax and making payment to the government, what this entity will do, this entity will generate a certificate called as TDS certificate, that is tax deducted at source certificate, and this TDS certificate is then given to the taxpayer. Taxpayer means, let's say in this case, the dividend, the shareholder, or a person who has got interest on bonds or deposit. Those persons will get a TDS certificate. And then what happens is, generally people file income tax returns at the end of the year. And at the end of the year, people will show that this is their taxable income. On that taxable income, that is their tax liability. That is how much tax they will have to pay. That is what people will show in their income tax returns. Now, while filing income tax, the taxpayers will take help of this TDS certificate and they'll show to the government, look, I have already paid tax indirectly here. I've already paid my tax and this is my tax liability. For example, let's say that in case of dividend to the shareholder is liable to pay, for example, including his total annual income, let's say is required to pay a total tax of, for example, 1 lakh rupees. But he has already paid the tax to the government indirectly, right? That is a TDS. And let's say the TDS which is deducted is 10,000. His tax liability is 1 lakh, but he has already paid 10,000. So he will pay only the remaining amount to the government. And how much is the remaining amount? 90,000. So that is where, when the tax liability is more than the tax paid. But it might so happen in certain cases where the tax paid might be more than the tax liability, right? So it might so happen that the person who has got, who's paid the dividend, right? He has paid dividend of tax on dividend of, let's say, rupees 10,000. But this particular person is not liable to pay tax at all. So his tax liability is 0, but tax paid on dividend is 10,000. So there, tax paid is more than the tax liability. So the person will get entire refund of 10,000 at the end of the financial year. You can see, if tax paid is more than tax liability, government will issue tax refund. If the tax paid is less than the tax liability, the taxpayer will pay the additional tax. This is how TDS would work. So you can see here the meaning of TDS: collection of tax at the point of generation of income. Wherever income is generated at that particular point of time, the tax is deducted. Why did we come out with this TDS? Basically, to reduce tax evasion and improve the tax compliance. If you see, in the year 22-23, TDS accounted for almost 40 to 45% of gross tax receipts of the government. But it is being said that there are number of problems in the TDS regime in India. And this is what we have addressed in the budget. Let's see what are the problems in the TDS regime. For example, the first problem here is it imposes higher compliance burden on the entity which is making payment. For example, let's say here the entity which is making payment could be a bank, it could be a company. On them, the compliance burden increases because while making payment, they are required to deduct the tax, pay tax to the government, and then issue TDS certificate to the taxpayer. Compliance burden on them increases. Second one is it imposes higher burden on the tax administration. Why does it impose higher burden? It is being said that almost 40 to 45% of TDS which the government collects, all of that TDS is refunded back to the taxpayers at the end of the financial year. Why does it get refunded? Remember, I told you this thing that if the tax paid is more than the tax liability, then the entire tax paid is refunded back. So here it will impose higher burden on the tax administration because they have to keep a track of who has paid how much TDS and how much tax refunds have to be issued. Apart from that, other problem, as you can see, for example, the amount of with respect to interest on the bonds, irrespective of how much is the interest on the bond, be it 10 rupees also or 100 rupees also or 1 lakh also, irrespective of that, the bank or the entity is required to deduct the TDS even for small value transaction. So if you're deducting TDS for small value transaction, the problem here is it imposes higher burden on the entity which is deducting the tax, and it will impose higher burden on the tax administration also. Apart from that, like I said, almost 40 to 45% of tax which is collected to TDS gets ultimately refunded back to the people at the end of the financial year. So the problem as far as the taxpayer is concerned, it will affect their cash flow. It means they would have to wait until the end of the financial year to get a refund of the taxes. Take for example, senior citizen. Senior citizens generally earn interest on the deposits with the bank. So the bank will deduct their tax at the source, and then the senior citizens would have to wait until the end of the financial year to get the tax refund. So in a way, it will affect the cash flows of the taxpayers. So the problem, if you look at the TDS regime here, is very simple. Ideally, TDS should come into play only when the payment which is made is very high amount, which means the threshold for TDS should be very high. If the threshold for TDS is very low, even for small value payments also, you will end up deducting the tax, unnecessary compliance burden on the entity, higher administrative burden, and it will affect the cash flow of the taxpayers as well. So one of the committee on income tax simplification, called as Justice R.V. Ishwar Committee, had recommended that we need to increase the threshold on which TDS is applicable. So only if the payment is made above certain threshold level, only then the TDS should come into play. If the threshold is, if the amount of payment which is made is very less, TDS should not be incorporated. Accordingly, what we have done, for number of transactions where TDS is applicable, we have decided to increase the threshold. For example, you can very well see if interest is earned on bonds, on securities, earlier there was no threshold at all. But now we have increased the threshold to 10,000. Same way for other transactions also, we have increased the threshold. Now, what you must know here is the above table does not include all the changes. And I don't even think that is important from the perspective of your prelims examination. So the above table which I have highlighted is just indicative in nature as to where the threshold rates have got increased. Second, should you have to remember the change in the threshold? I don't think so. That UPSC would ask you the threshold rates for deduction of TDS. So that is what is TDS. Tax is deducted at source. There is almost a similar concept and often quite confusing, and that concept is TCS, that is tax collected at source. Let's understand what is this tax collected at source. Just to make you understand the difference between TDS and TCS, I've incorporated the flowchart for TDS. So keeping this as a reference, let's understand TCS, tax collected at source. Now, in case of tax collected at source, let's say there is an entity. This entity is accepting payment. It means, for example, this entity is selling something, or let's say it is accepting the payments. For what? For example, let's say it is accepting payment upon sale of timber or forest produce, or it is accepting payment for mining lease. It is accepting payment when it leases out toll on national highways, or let's say parking lot, or let's say you are making foreign remittances. In these transactions, the tax collected at source is applicable. What is this tax collected at source? Let me just give you some examples. Here, that is in TDS, what used to happen is the entity which is making payment, while making payment, it used to deduct the tax amount and pay only the remaining amount to the these people, right? But in case of TCS, tax collected at source, when the entity is accepting payment, along with the payment, the entity will also collect the tax. It is collecting tax. There, what it was doing, it was deducting the tax amount. Here, it is collecting the tax from the buyer. Let me simplify this through an example. Let's say there's a forest department. This forest department is selling timber to a particular entity. Let's say this particular entity is into wood business. So when it is selling timber to such an entity, let's say the cost of the timber is, for example, rupees 100. Ideally, how much money it should collect? 100 rupees now. But what did I say? When it is accepting payment, it will accept the payment for timber also, and it will accept the tax also, which means the entity will ask the entity which is purchasing the timber to pay, say, 10 rupees additional tax. So it is accepting total 110. Once it accepts 110, 100 rupees it will keep in its pocket. 10 rupees it will pay as tax to the government. So is there any tax burden on the forest department in this case? Absolutely not. Because the 10 rupees is paid by a buyer of timber, a wood company, right? Same way, let's say the government is issuing mining lease, toll plaza lease, parking lot lease to a company. So whenever it is accepting payment, along with the payment, it will collect the tax also at a rate which is prescribed by the government. Same, if I am making a foreign remittance, let's say I'm sending money to other country, let's say I might be sending money to other countries to invest in, say, shares, bonds in US. So let's say I'm sending, for example, $100. Government might ask the bank in this particular case through which I'm making the foreign remittance to collect $20. So when I am sending money, I'll send $100 only, but I will have to pay $20 as a tax to the bank, and the bank will on my behalf pay that tax to the government. That is what is TCS. The logic is once again similar to TDS. So the entity which has accepted the tax, that entity will generate, in this case, TCS certificate. In this case, the entity is saying, look, I have already collected tax from this person and I have deposited this tax with the government. You can use this particular TCS certificate to claim tax refund. So income tax payers will file IT returns wherein they'll show tax liability in the tax paid, and the same logic will come into play here. So even with respect to TCS, now we have undertaken a rationalization. What is that rationalization? Let's see here. Now, as far as the threshold for collecting the TCS on foreign remittances, this has got increased from rupees 7 lakh to 10 lakh. So earlier, we were required to make this TCS payment if you are sending money of up to more than 7 lakh. Now, if you are sending money of more than 10 lakh, only then TCS will come into play. If you are sending less than 10 lakh, then there is no TCS. That is what is tax collected at source. So as you can see, there is a very minute difference between TDS and TCS. So to avoid confusion, just know this. TDS means tax is deducted at a source. So the entity, while making payment, will deduct the tax. That tax the entity will pay to the government, and only the remaining money is paid to the concerned person. TCS means while collecting the payment, along with the payment, the entity will also collect the tax. So that is a very minute difference between TDS and TCS. Now let's move to the next concept of transfer pricing. So what is this transfer pricing and what important change has been introduced in this year's budget? Let's understand that. So when you look at transfer price, you can look at the definition of transfer price. Transfer price is a price at which a parent or a subsidiary company will sell its goods and services to another subsidiary company. For example, within India, all of you must have heard of a company called as Tata Sons. Tata Sons is a parent company. Within Tata Sons, you have multiple subsidiary companies. Let's say Tata Steel, Tata Motors, or TCS. So when transactions are taking place between these subsidiaries, the price at which transactions take place, that price itself we will call it as transfer price. For example, let's say you have Tata Motors. Tata Motors can purchase steel from Tata Steel, or Tata Motors can purchase a software from TCS, Tata Consultancy Service. So the price at which Tata Motors purchases steel from Tata Steel, this price we will call it as transfer price. Same, the price at which Tata Motors purchases software from TCS, that is transfer price. Ideally, can I say the transfer price should be lower than market price, right? Ideally, because here the transactions are taking place among the companies which are related to one another. But at an international level, if there are two companies which are like subsidiary companies, and these two companies are located in two different countries, One country has high tax and other country has low tax. And if transaction is taking place between these two companies, the transfer price is generally lower than the market price, generally higher than the market price. Why is transfer price higher than the market price? Let's see this through an example. Okay, let's see here. For example, let's say there is company A. This company A is a subsidiary company registered in country X, and country X has high tax rates. And company A is a car manufacturing company. It is manufacturing cars. So because a company A is based or registered in country X, company A will have to pay tax in country X only. Now, like I said, company A is a subsidiary company. So there should be some parent company also, no? So let's say company B is a parent company, and this parent company is registered in country Y, and this parent company is manufacturing tires. And country Y has low tax. So because company B is registered in country Y, company B has to pay tax in country Y only. So company A will pay tax in country X. Company B will pay tax in country Y. Company B is a parent company. Company A is a subsidiary company of that parent company. So this is the setup. Now look at the example which I made. One is a car company, other is a tire manufacturing company. So let's say this is a car company, and because it's a car company, it's a raw material. It needs a raw material, which is a tire. In country X, for example, it can purchase tire at just $1. Just $1, it can purchase a tire. But what will company do? Company A will do, it will purchase tire from company B. And I told you what is transfer price. Transfer price is a price at which transactions take place between two related companies, right? So company A will purchase tire from company B, and deliberately it will purchase tires at a higher price. So transfer price is much higher than the market price. So let's say it is purchasing tires at $10. So you must be thinking, sir, why will it purchase tires at $1 when it can purchase tires in country X only at $1? The reason is very simple. You can see here, in country X, it will show higher operating cost because it will say, look, I'm purchasing tire at a higher price. So my operating cost is higher because the cost of raw material is higher. So operating cost is higher. It means the company on record, on its paper, will show lower profit. By showing lower profit in country X, why lower profit in country X? Because country X has high tax rate. By showing lower profit, it will end up paying less tax in country X. On the contrary, look at that side. In country Y, company B will show higher profit. Because it is showing higher profit, in country Y, there's no problem because country Y has low tax rate. So country Y has low tax rate, so it will end up paying less tax. So can you look at the arrangement which the company has done? So deliberately it is showing that it's purchasing the raw materials at a higher price. By doing so, in one country where the tax rate is higher, it is showing low profits and hence paying less tax. In other country where the tax rate is lower, it is showing higher profit, but because the tax rate is lower, there also the company is not paying enough amount of tax. This is what is called as base erosion and profit shifting, BEPS, In fact, this was a question which was asked in one of the prelims earlier. Why are we calling it as base erosion profit shifting? Number one, profit is getting shifted from a country where the tax rates are higher to a country where the tax rates are lower. Second, when they shift profit, what is happening to tax base of a company, that is the tax liability of a company? It is reducing, right? So now at a global level, what we generally do is we generally try to ensure that the transfer price is almost same as the market price. It means we will allow company A to purchase tires from company B, but we will ensure that it is purchasing tire at a market price and not at a very high price. For example, if the market price is $1, we will ask company A, look, you have to buy tires from company B at somewhere around $1 and not more than that. Now, this is a kind of agreement which takes place between the tax officials of a country and the companies. So in this particular agreement, tax officials and companies will come together and they will determine what is the transfer price. This agreement, which is signed between the companies and the tax officials, we call it as Advanced Pricing Agreement, APA. Hope you have understood what is this Advanced Pricing Agreement. Basically, this is determined what should be transfer price. And this is determined through negotiation between tax officials and the company. And transfer price is generally should be equal to the market price. So let's see what is the latest budget announcement with respect to transfer price. So now if you see, the transfer price is fixed every year right now. It means every year the transfer price is fixed in the advanced pricing agreement, which imposes compliance burden on the companies also and the tax officials also. Remember in the first discussion of ours, we discussed that one of the core theme of this year's economic survey is to go for systematic deregulation to improve the ease of doing business. Accordingly, in this year's budget, the finance minister has highlighted that transfer price, which was so far fixed every year, would be fixed once in 3 years. So this is in turn reduce the compliance burden. So this is about transfer pricing. So the details of advanced pricing agreement I have highlighted here. I hope you should be able to go through. Next one is with respect to crypto assets. So until 3 years back, there was a lack of clarity with respect to whether people should pay tax on the profits which they make on selling cryptos. There was lack of clarity. But almost 3 years back, the finance minister decided to bring crypto assets under the ambit of tax. So now there is capital gains tax when you make profits on selling the crypto assets. For example, if I purchase a Bitcoin at, let's say, $100, and if I sell Bitcoin at $200, which means I made a profit of $100. On that $100 profit, I am required to pay capital gains tax of 30%, which is like $30. So this is a new development which has taken place 3 years back. So this is capital gains tax on crypto assets. Apart from that, 3 years back, the government has given what is the meaning of crypto asset. In fact, in our Income Tax Act, we don't use the word crypto asset. Rather, we use the word virtual digital asset. Please look at the definition of virtual digital asset. It says any information or a code or a number or a token which is generated through cryptographic means. And look at the characteristic. It should be used for financial transaction. That is one. Apart from that, it can have a inherent value, or it can function as a store of value, or it can be used as a unit of account. So think of Bitcoin. Bitcoin is used for financial transaction or investment. It is a store of value, though Bitcoin might not have a inherent value, right? So the definition that we have come out with virtual digital asset is very all encompassing to ensure that all types of cryptos are under the ambit of tax. So you can see the examples of virtual digital assets. It includes Bitcoin, altcoins which are alternative to Bitcoins. It can also include stable coins plus non-fungible tokens, NFTs. What is not a virtual digital asset? You can see CBDC. CBDC is not a virtual digital asset, central bank digital currency. Apart from that, non-fungible tokens whose transfer will result in transfer of the ownership of the underlying intangible, tangible assets. So if there's a trading of NFTs, and because of trading of NFTs, if the underlying tangible assets also gets transferred, then it is not actually a virtual digital asset. Only those NFTs whose trading does not lead to transfer of underlying tangible asset, they are considered as virtual digital asset. Why is it important? See, recently, when G20 summit was held, in the G20 summit, there was a New Delhi declaration. In this New Delhi declaration, we have decided to, increase the reporting mechanism for crypto trading. So what actually happened is, in the G20 leaders, the New Delhi declaration called for swift implementation of crypto asset reporting framework. Now, what is this crypto asset reporting framework? Basically, this particular framework stated that all those entities which are facilitating transactions in cryptos, take for example, let's say crypto exchanges, crypto wallets, all these entities should proactively disclose the names of the people who are involved in trading of cryptos. That is what the New Delhi declaration called for. Accordingly, in this year's budget, two developments have taken place, wherein the finance minister has added a new section in Income Tax Act, which puts obligation on entities such as banks, crypto exchanges, as well as wallets to furnish information whenever people carry out transactions in cryptos. That is the first thing. And second, we have decided to add a new definition to cryptos. What is that new definition? As per the existing definition of crypto or virtual digital asset, it is a information, code, number, token which is generated through cryptographic means, right? Now what we have done here is, we have almost kept the same thing, but to that we have added distributed ledger technology or any similar technology. Now why we have added the new definition? Basically, this was one of the recommendation which was part of this crypto asset reporting framework, to have a wider definition, which means not just to cryptographic means, but even those cryptos which are generated through almost similar technology should also be included in the ambit of virtual digital assets. Probably in times to come, we'll get to know which particular cryptos the government is actually trying to target by widening the definition of virtual digital asset. These developments become important because in prelims, you might get a question on what is included as a virtual digital asset in India. That is why I have covered this topic. Next is Sovereign Wealth Fund. So what is this Sovereign Wealth Fund? Let me discuss this. Let's say there's an individual. This individual has surplus amount of money. Now what this individual generally does when he has surplus amount of money is this individual will make some investment. Probably he may make investment in shares, bonds, or in the form of deposits, so that on that surplus money which is remaining unutilized, he can make good returns. That is what a individual does. Same logic, there are certain countries. These countries may have surplus amount of money. How do they have surplus amount of money? For example, there might be some countries which have huge forex reserves. There are certain countries wherein the tax collected by them might be higher as compared to their expenditure obligations. So just like how a individual has surplus money and the individual will make investment, similarly if a country has surplus money, that surplus money the country would make investment. It can make investment either in its own country, or it will make investment in other countries where it thinks the profits are likely to be higher. That is what is Sovereign Wealth Fund. Look at the word sovereign. Sovereign means it is entirely owned by the government, 100% owned by the government. Second word, wealth. This money is used to generate wealth by making investment. So this is a basic philosophy of Sovereign Wealth Fund. So you can see features of Sovereign Wealth Fund. It is government owned fund. It has money. How do they get money? They may have surplus forex reserves. They may have surplus tax receipts, right? They may have undertaken privatization and so on. So with that money, what they generally do is they may invest in physical assets like road, ports, airports in other countries, or they may also make investment in financial assets in other countries where they think they are likely to make more profits. So think of it. You have countries such as Norway, UAE, which have set up their own sovereign wealth fund. For example, in case of Norway, because Norway enjoys fiscal surplus, it has created a sovereign wealth fund called as Norway Government Pension Fund. It is considered to be world's largest sovereign wealth fund. Same in case of China. China has created its own sovereign wealth fund from its forex reserves. There are some other details about sovereign wealth fund. You can just go through that for your prelims examination. Now, why is it important is because, as you can see, in India, we had provided tax exemption to the sovereign wealth funds. And this tax exemption on sovereign wealth funds was applicable on interest income, dividend, capital gains tax earned by the sovereign wealth fund. But this tax exemption was applicable only until March 31st, 2025, which meant beyond March 31st, 2025, these sovereign wealth funds would not get any tax exemption. You must understand that there is a kind of symbiotic association between sovereign wealth funds of other countries and India. The sovereign wealth funds of other countries are looking for making investment in the countries where they think the returns are higher. Obviously, India is one of the fastest growing economy. So if they make investment in India, they are likely to get higher returns. So it is going to benefit them. As far as India is concerned, you must understand India is an investment hungry country. We want to become Viksit Bharat. To become Viksit Bharat, we need to attract more investment from sovereign wealth fund. So there is a kind of symbiotic association between India and sovereign wealth funds of other countries. So if you don't provide them tax exemption after March 31st, 2025, we might not be able to attract the sovereign wealth funds. Accordingly, in this year's budget, we have decided to continue with the tax exemption for sovereign wealth funds for another 5 more years, that is until March 31st, 2030. So this is a new development with respect to sovereign wealth fund. Why is it important? Because in prelims 2017, there was a question related to National Investment and Infrastructure Fund. According to some economists, not officially, but according to some economists, this National Investment and Infrastructure Fund is also a kind of quasi sovereign wealth fund of India. Now, why am I saying quasi? Because generally, if you look at sovereign wealth fund, one of the characteristics of sovereign wealth funds is that they are 100% government owned funds, right? But in case of India, if you see National Investment and Infrastructure Fund, it is 49% owned by the government. Remaining 51% is owned by private investors. Private investors include both domestic investors as well as foreign investors. So because there is not 100% government ownership in this fund, that is why we call it as quasi. That's the first difference. Second difference here is sovereign wealth funds of other countries generally focus on making investment in other countries like Abu Dhabi Investment Authority or Singapore's sovereign wealth fund. When it comes to our own quasi sovereign wealth fund, because we are already an investment hungry country, we are not trying to make investment in other countries. We are making investment in infrastructure projects in our own country. So that is one major difference between sovereign wealth funds of other countries and India. So with respect to NIIF, I have incorporated the details here. We can just see NIIF. It has a initial corpus of 20,000 crore. Total corpus is 40,000 crores. Government has 49% ownership and private investors they have 51% ownership. So if you go back to the question, it is an organ of NITI Aayog. This is incorrect. It has a corpus of 4 lakh crore, which is also incorrect because if you see the corpus is 40,000 crores. So based upon that, the second statement is also incorrect. Answer is neither one nor two. Look at the practice MCQ number 14. Sovereign wealth fund is a government owned fund that invests in physical and financial assets, right? NIIF is 100% owned by the Indian government, incorrect. Sovereign wealth funds enjoy tax exemption on their income earned through investment in infrastructure assets in India. It is right. Answer is 1 and 3 only. Let's move to the last set of announcements in the Finance Act. The first one is with respect to extension of tonnage tax scheme for the inland vessels. So let's understand what is this tonnage tax scheme first. Okay. See, there are number of shipping companies in India, and these shipping companies, they are generally involved in movement of goods for the international trade. So whenever India is importing goods or exporting goods, the import and export of the goods will take place through the ships owned by these shipping companies. Now question is, how do you ask the shipping companies to pay the tax? One way for the shipping companies to pay taxes, we can ask them, look, calculate your profits every year, and on that particular profits you have to pay the tax, right? Which is generally the case even for the corporate companies also in India. But there's a problem as far as shipping companies are concerned. The problem here is the profits of the shipping companies, they are very volatile. Sometime they may increase and sometime they may reduce. That is problem number one. Problem number two is, if we ask them to keep a detailed account of the profits which they are earning, it will impose higher compliance burden, because for each and every ship which is used for transportation of goods, they are required to maintain accounts of how much profits they have earned, which in turn increases the compliance burden on the shipping companies. So what we do, we don't follow this approach. Instead, what we say is, based upon the tonnage of ships owned by the shipping companies, there's a capacity of the ships with respect to movement of cargo, right? Which we call it as tonnage, how much goods they can carry. So with respect to capacity of ships, with respect to movement of goods, we say you assume or you try to calculate as to how much is your profit. The government has said, look, if your capacity of the ships to carry goods is this much, you need to pay this much amount of tax. If the tonnage, that is capacity of the ships to carry goods, is higher, they'll pay more tax. If the capacity is lower, they'll pay less tax. So this is what we call it as presumptive taxation. Presumptive taxation means, rather than calculating the actual profits, we are presuming that this could be the profit of the shipping companies, basically to reduce the compliance burden on them. So you can see here, instead of being taxed on the profits, shipping companies are taxed on the net tonnage of the ships and the days involved. How much is the capacity of the ships and for how many days the ships are on sea. Based upon that, they'll pay the tax. Do not get into the actual calculation part. The idea here is, it will reduce the compliance burden, it will give more tax certainty, and more importantly, all other countries follow this kind of taxation for their shipping companies and not just India. So we already have this scheme for the shipping companies. But the problem here is, this particular scheme is applicable only for sea-going ships. Sea-going ships basically means the ships which are involved in international trade, or the ships which are involved in coastal trade, that is along the coastal areas. This benefit is not applicable to inland shipping vessels. Inland shipping vessels means, say within India, if we want to move goods through rivers, we call it as inland waterways, right? So this benefit is not applicable to inland shipping vessels. So now what we have done is to give a thrust to inland waterways, to encourage the shipping companies in inland waterways. We have decided to extend this scheme even to inland water transportation as well. So already government has taken a number of steps to promote inland waterways. For example, we have declared more than 100 national waterways in India. And among those initiatives, this is the next initiative for the inland waterways. Next one is the tax relief for the startups. For that, you need to understand the definition of startup. A startup is a company which is up to 10 years old, plus in those 10 years, the total turnover of a company should be less than 100 crores. You must understand, these two conditions should be simultaneously satisfied for a company to be called as startup. What do you mean by simultaneously satisfied? For example, let's say there's a particular company. This company might be just 5 years old, but within this 5 years, its turnover, for example, has increased to 200 crores. Because one criteria is not getting fulfilled, it will not be considered as a startup. Second, let's say there's a company whose turnover is just 80 crore, but this company is 11 years old. In this case, the turnover criteria is satisfied, but it is 11 years old, which is more than 10 years, right? So this criteria is not satisfied, so it will not be considered as a startup. So that is the definition of startup. Second, startups in India get tax benefit. What tax benefit? I told you a company is considered as a startup for a period of 10 years. So in those 10 years, anytime, I repeat, anytime for 3 consecutive years, the startup can claim 100% tax exemption. So please understand, 100% tax exemption is not on just first 3 years. We say during those 10 years when you are a startup, during those 10 years for 3 consecutive years, you can claim 100% tax exemption. This is a benefit which we are given. But this benefit is applicable only to those startups which are incorporated after 1st April 2016 and before 1st of April 2025. You can look at the date 1st April 2025. It means if startups are registered after 1st April 2025, they may lose out on tax exemption, right? So if you see India, it is being said it has a third largest startup ecosystem. More than 100 companies, startups have become unicorns in India. And they are largely benefiting the Indian economy in terms of job creation. So accordingly, what we have done in this year's budget is we have decided to extend the tax exemption for the startups for additional 5 years, that is until 1st of April 2030. So even those startups which are registered after 1st of April 2025, they will get the tax exemption. So this is the new development with respect to startups. Now coming to the last announcement in the budget with respect to NPS Vatsalya Scheme. All of you know about new pension scheme, national pension scheme, right? National pension scheme, you must understand it is for the government employees also, and it is for the normal citizens also. That is when people like you and me who are not government servants, even we can enroll ourselves under the national pension scheme. So under national pension scheme, we can make some contribution, but the only difference is for government employees, government will make some contribution, but for citizens, there's no contribution from the government. So it's basically a pension scheme for both government officials as well as the citizens. So in September 2024, the Pension Fund Regulatory Development Authority has launched NPS Vatsalya Scheme. What is this scheme? This scheme will enable the parents to start NPS account for their minor children below the age of 18. So, the parents can open an NPS account for their minor children and they can start contributing to that particular account on behalf of the children. This scheme is called as NPS Vatsalya Scheme. So parents will make contribution to the account of the minor till they attain the age of 18 years, right? So that is this particular scheme. The details of this scheme are just incorporated here. I hope you should be able to go through, but I want you to focus on the budget proposal. Budget proposal here is if amount is deposited in a minor's account, if parents are depositing some amount in the behalf of the minor children, then they can claim a tax deduction up to maximum of rupees 50,000. Remember I told you about deduction, right? Which is there under old tax regime. So if a parent is making contribution to NPS Vatsalya, and they can claim 50% maximum 50,000 as a deduction from their total taxable income and pay tax accordingly. But if the amount is withdrawn at the last, then the tax is liable. So amount is taxable upon the withdrawal. So you must have seen that in the previous year prelims, to be more specific, in prelims 2024, there was a question about Pradhan Mantri Shram Yogi Mandan. Accordingly, this scheme also becomes important, that is NPS Vatsalya. So please go through this particular scheme. Okay. Apart from that, I have also incorporated in my PPT about the Finance Commission recommendations and the recent controversy with respect to rising surcharge and cess. So look at the previous year questions with respect to Finance Commission, right? And look at the recent articles related to Finance Commission. So all the details related to Finance Commission I have incorporated in the slide. Now I do assume that most of you may have studied Finance Commission already as part of your static, that is core. Now what you can do is you can simply go to the PPTs, try to revise some recent news related to Finance Commission. After going to the PPTs, please try to solve these practice questions, right? And if you have a doubt, obviously you can drop me a message in the comment section. I will resolve your doubt there with respect to Finance Commission. The next one is with respect to the global minimum corporate tax. Recently, US has decided to withdraw from the global minimum corporate tax deal. And this is quite important for your upcoming prelims examination. The reason is very simple. Like I said, generally UPSC focuses on the important taxes in news. One tax which is in news was STT, which I've already highlighted. Second important tax which is in news is global minimum corporate tax. So this particular article I have covered it in one of the current affairs class. So I will be sharing the link to this particular article in the description box. So one article is STT, second article is global minimum corporate tax. So after going through this article discussion, you can try to solve this practice question. Now let's move to the last part, that is composition of expenditure. That is where is the government spending money? So this shows the breakup of the expenditure of the government. So just like how we discussed, the highest receipts of the government, same way you need to focus upon the highest expenses of the government. So as you can see here, the highest expenditure incurred by the government is on number one, state share of taxes and duties, which is something which is transferred to states based upon the recommendations of Finance Commission. It is followed by interest payment, and the last one is central sector schemes. What are central sector schemes? Central sector schemes are those schemes where 100% of funding is provided by the center, and these schemes are implemented by the central government only. Such schemes we call it as central sector schemes. And please see here, the expenditure incurred on central sector schemes is more than that on centrally sponsored schemes. Okay, this particular graph shows the trends in expenditure. So can you see what has happened to the overall capital expenditure and effective capital expenditure? Overall capital expenditure as well as effective capital expenditure have increased. What is effective capital expenditure? Effective capital expenditure is capital expenditure by the center plus grants which the center gives to the states for creation of assets. If you add these two, what we get is effective capital expenditure. In terms of absolute value, both capital expenditure and effective capital expenditure have increased. This is what you can very well see here. But if you see, with respect to capital expenditure and effective capital expenditure as percentage of GDP, if you convert that into percentage of GDP, there is a marginal decrease in the effective capital expenditure as well as the capital expenditure. These trends are quite important. That is why I'm covering this. So please make a note of this. These are the questions which have been asked repeatedly with respect to deficits or debt, which I have clearly shown here. Let's move to the next one, which is trends in deficits. So this particular graph shows how deficits have changed in the last 4 to 5 years. Let's quickly have a look at the trends. Number one, during COVID, there was large scale increase in fiscal fiscal deficit. That is quite understandable, right? Because during COVID, the government had to borrow more and undertake expenditure. So fiscal deficit increased to all-time high of 9.2%. But since then, can you see what has happened to the fiscal deficit? So since then, government has focused on fiscal consolidation. Because of the fiscal consolidation in the last 4 years, fiscal deficit has got reduced. And in the financial year 24-25, it is expected to be at 4.8%. There has been decrease in both in revenue deficit, effective revenue deficit, as well as primary deficit. But there's something more important which I wanted to cover here. All of you know that under FRBM Act, the target was to reduce fiscal deficit to 3% of GDP by 31st March 2021. But because of COVID-19 pandemic, we could not fulfill the target. So the finance minister later made a commitment in the budget speech of 21-22. The commitment made by the finance minister was, over a period of time, we will reduce the fiscal deficit to below 4.5% by financial year 25-26. That is, by next financial year, it will reduce to below 4.5%. And can you see? By end of next financial year, it is expected to be 4.4, which is below 4.5%. That is first thing. Second thing is, now in the recent budget, generally in the budget document, there is one document called as macroeconomic framework statement, which is mandated to be presented because of FRBM Act. In this particular document, macroeconomic framework statement, the finance minister has outlined the new line of thinking on the fiscal consolidation कि आगे हम कैसे करेंगे. So far, for us, the FRBM Act was a kind of a target. Under FRBM Act, the target was fiscal deficit 3% by 31st March 2021, and the combined debt of center and state should reduce to 60% by end of 31st March 2025. So that was a guiding light, right? FRBM Act. But now the finance minister has highlighted a new line of thinking on fiscal consolidation. What is this new line of thinking? How is it different from FRBM Act? Let's see this. Number one, finance minister has highlighted that we will shift from rigid annual fiscal deficit target to more flexible fiscal deficit target. Under FRBM Act, the fiscal deficit target was very rigid, right? Like we used to say, 31st March 2021, it should reduce to 3%. It was very rigid, which made it difficult for the government to deal with situations such as the recession caused due to COVID-19 pandemic. So in a way, the government hands were tied because of FRBM Act. So the finance minister has said, we will not follow rigid fiscal deficit target. Rather, we will have flexible fiscal deficit target. But how flexible will be the fiscal deficit target? For that, the finance minister has highlighted debt to GDP ratio will be fiscal anchor. What do you mean by fiscal anchor? Fiscal anchor means what will be our long-term target. Our long-term target will be debt to GDP ratio. And what is that long-term target? In the statement, it is highlighted that the long-term target of debt to GDP ratio would be 50% plus or minus 1%, like 49 to 51. And that target would be met by 31st March 2031. So this is our anchor now. This is our long-term target. This will what will guide how we will reduce the fiscal deficit. So now fiscal deficit will be the only operational target. What do you mean by only operation target? Operational target, only operational target means will not be targeting revenue deficit, will not be targeting effective revenue deficit, will not be targeting primary deficit. We will fix target for fiscal deficit every year. And those targets we will fix based upon what are the present economic situations. As the economic situations change, the target for the next year might also change accordingly. But we will reduce the fiscal deficit in such a way that by March 2031, the debt to GDP ratio should be between 49 to 51%. You can see government would endeavor to keep fiscal deficit in each year such that government debt is on the declining path. So this is a new change which has been incorporated in the macroeconomic framework statement this time. Hope it's clear with respect to trends in deficits. With respect to sources of deficit financing, that is, like I said, this time the government has borrowed somewhere around 15.5 lakh crore. From where has the government borrowed 15.5 lakh crore? You can see the highest share is of market borrowings. This is highest, and you can see it is somewhere around 11.5 to 12 lakh crore. And this is followed by securities against National Small Savings Fund. That trend which has been following since last 2 to 3 years, the same trend has continued for this year also. Why it is important? You can see this question asked in Prelims 2022. This was a question which was asked in Prelims 2022 precisely with respect to government borrowings. That is why it becomes important. Now coming to the debt status of the government. So I told you the difference between fiscal deficit and debt. Fiscal deficit tells us how much money the government has borrowed for 1 year. Debt, on the other hand, tells us the total accumulated borrowings of the government, right? So the total accumulated borrowings of the government is 180 lakh crores. And this, we generally express it as percentage of nominal GDP. And at the start of our discussion, I told you nominal GDP is somewhere around 324 lakh crore. So if you convert this, total liabilities of the government, this will be 56%. The total liabilities of the government can be categorized into public debt and liabilities under public account of India. I told you that people deposit money with the government. All of that money goes into public account of India. It is not government's money. It is people money. government is liable to pay it back. So it becomes liabilities under public account of India. And this is the public debt, which is the borrowings of the government. Between these two, we can see public debt is almost 50% of GDP. Public debt can be in turn categorized into two: internal debt and external debt. Internal debt means domestic borrowing, external debt means external borrowings. And can you see between these two, our internal debt is way higher than our external debt. Within the internal debt, the same trend has continued from previous year. That is, highest borrowing is from dated securities. And within the external debt, the highest borrowings is from from international institutions, multilateral institutions. Apart from that, there are some prelims pointers about government borrowings. Let's look into that. Number one. See, with respect to dated securities, government borrows money through dated bonds, right? These bonds have three characteristics. One, they'll have a face value, which denotes how much money the government is borrowing. They will have a maturity, which denotes for how many years the government has borrowed money, for example 10 years. And third one is the coupon rate, that is the interest rate. Now, with respect to coupon rate, there are two types of government securities. One is fixed rate government bonds. Fixed rate government bonds means the coupon rate on these government securities will always remain same throughout the tenure of the bond. For example, the coupon rate, for example, is 5%. Until the maturity of 10 years, the government will pay only 5% interest, irrespective of the changes in market conditions. There is second type of government security, which is called as floating rate government security, wherein here the coupon rate on the government securities keep on fluctuating, keep on changing based upon the market conditions, right? So those government bonds, we call it as floating rate government bonds. So sometimes the coupon rate on these government bonds could increase or decrease based upon the market conditions. What you must understand from the perspective of prelims is majority of the money borrowed by the government is in terms of fixed rate bonds. There are only few government securities which are in the form of floating rate bonds. Why is it important? It is important because it insulates, it protects the government from volatility in the interest rate. Because majority of the government borrowing is in terms of fixed rate, even if the interest rate in the market increases, the liability of the government to pay more interest reduces or remains same, simply because majority of the government bonds are fixed rate bonds. That is one important thing that you should know for prelims. Imagine if majority of the borrowings are in floating rate bonds. If market rate of interest increases, what will happen to coupon rate on these bonds increases? So government will face more volatility from interest rate, right? Second, maturity profile of the debt. It means what is the average maturity of the bonds. You can see government generally issues bonds of different maturity periods, like 1 year, 2 year, 5 year, 10 year, 15 year, 20 year. Sometimes it may go up to 40 years. But on an average, the average maturity of the bonds, the weighted average, if you see, the weighted average is around 11 years, which means mostly the government borrowings are long term, which is good. And lastly, who are the entities who are buying maximum amount of government bonds? They are generally bought by commercial banks, followed by insurance companies and pension fund companies. In fact, the share of FPI investment in government bonds is quite less. So majority of investment in government bonds is coming from domestic banks and insurance companies. These are some prelims pointers related to debt. The last one which I wanted to tell you is about NITI Aayog's Fiscal Health Index. So recently, that is last month, NITI Aayog has come up with Fiscal Health Index. In this particular index, NITI Aayog has carried out a detailed study of fiscal health of the states. Based upon that detailed study, NITI Aayog has ranked the states in terms of their finances. Why is it important? Because so far we have discussed the central government budget. Similarly, now I do think a lot of focus has to be given to state finances also. The reason is very simple. A lot of states have borrowed heavily to fund the freebies, such that their debt to GDP ratio has increased. In fact, the NITI Aayog has highlighted that the financial position of some of the states, such as Punjab, West Bengal, Kerala, has deteriorated. So, because the focus has now shifted to the finances of the states, this becomes quite important for your prelims examination. But here, what I want to tell you is I have covered this particular article in much greater detail in the recent current affairs video. So, in this particular video, I have discussed everything related to finances of the states, including the fiscal health index. So, you can see it is a snapshot of state finances in charts. It's a trend in fiscal deficit, outstanding liabilities of the states. What are the reforms which are needed with respect to finances of the states, which might become important for your mains examination. So all these things I've already covered in the current affairs class. So I will be providing you link in the description box below. So there will be 3 links in the description box. One is about STT, Securities Transaction Tax. Second one is Global Minimum Corporate Tax. And the third one is Fiscal Health of the States. Please go through these 3 articles so that your preparation as far as public finance is concerned, both for central government and state government, is completed by going through these videos. So finally, we have come to the end of this particular discussion. So we'll be taking up the next discussion, that is the discussion on banking and finance. And this particular video will be uploaded tomorrow. Thank you so much. Keep studying.